The United States just flipped the global trade table, and the ripple effects are hitting everything from consumer wallets to Fed policy. Let's talk about what's really happening behind the scenes with these new tariffs, and what it could mean for growth, inflation, unemployment, and whether or not we're sliding toward recession. The big story? Tariffs. A lot of them. Fast. At the beginning of this year, effective US tariffs sat at around 3%. Fast forward to now, after the March 26th auto tariffs and the April 2nd reciprocal tariff announcement, that number has shot up to 22%. That's a level we haven't seen in nearly 100 years, going back to the Smoot-Hawley era during the Great Depression. And yes, this is a deliberate shift back toward protectionism. Now here's the key question. Will these tariffs stick around? Well, that depends. The administration sees tariffs as a strategic tool to rebalance trade relationships, lower deficits, reduce asymmetry in tariff rates, and ideally push trading partners to the negotiating table. So yes, tariffs are going into effect short-term. But over the course of the year, some deals might bring certain rates down, though it's unlikely they fall below a 10% floor. That said, don't expect clarity anytime soon. This is a chaotic policy environment with multiple possible outcomes, and everything is on the table. So who's likely to get a deal with the US? Goldman Sachs thinks India and Japan are best positioned to negotiate partial or full agreements this year, possibly wrapping up by December. China and Vietnam? Not so lucky. Tariffs there could be longer lasting, especially since the US wants to de-risk from certain Chinese industries. And Europe? They'll likely see uneven tariffs by sector, some hit harder than others. The timing here is key. These deals won't form overnight. Think months, not weeks. Which means, in the short run, trade disruption is almost guaranteed. And this sudden shock is already bleeding into the economy. Let's talk growth. The narrative at the start of the year was slower growth, stickier inflation. But with tariffs implemented earlier and at much higher levels than expected, that has now shifted to even slower growth and sharply firmer inflation. Goldman's revised forecast? Real GDP growth drops from a previously expected 1.5% in 2025 to just 0.8%. In 2026, it falls to 0.7%. That's a sharp slowdown. Consumer spending is also taking a hit. High tariffs act like a tax, especially on lower and middle-income households. Growth in real private consumption is basically flat through the end of this year. But despite weak demand, GDP barely stays positive because import volumes collapse. Front-loading in Q1, followed by higher costs, leads to fewer imports, helping boost net exports on paper but not in reality. Business investment is also down. Earlier projections were much rosier on spending for equipment, IP, and structures. But in light of weaker demand and rising uncertainty, growth in those areas has been shaved down. Residential investment? Still weak. Elevated mortgage spreads are suppressing new starts and transactions. In short, the real economy is slowing, and the deepest softness is expected to hit in late 2025 and early 2026. But that's not all. There's inflation. Tariffs are inflationary by nature, and that's exactly what's playing out. Goldman now expects headline PCE inflation to peak at 3.4% and core PCE at 3.9% by the end of 2025. That's up significantly from earlier estimates. The biggest source of pressure is goods inflation. Tariff-related price increases are filtering through. On top of that, reduced immigration is making it harder for services inflation to fall, especially in labor-intensive industries like retail, hospitality, and healthcare. Even if oil prices fall and soften headline numbers, core inflation remains elevated. In Q3 2025, Goldman forecasts quarterly inflation will peak at an annualized rate of 4.5% headline and 5.2% core. That's very hot. So what does the Fed do? Chair Jerome Powell already acknowledged that these tariffs have shifted the Fed's thinking. He said the economic effects will include higher inflation and slower growth, and critically, that the size and duration of those effects are still unknown. And while the Fed wants to look through inflation, it's going to be hard, especially when inflation is running hot and growth is faltering. So Goldman sees the Fed holding rates steady all year, no cuts in 2025. Rate cuts are now expected to begin in March 2026 at a gradual pace, 25 BPS per meeting, until reaching a terminal rate of 2.50% to 2.75%. Now let's turn to unemployment. Labor market growth is slowing fast. Average monthly job gains are projected at 100,000 in Q2, then dropping to just 25,000 by Q4. In 2026, things stabilize, but at a very weak level. Unemployment does rise, from the current low 4% range to 4.9% by end of 2026, but it's still relatively close to the Fed's estimate of long-run full employment. The point is, inflation is deviating much more from the Fed's 2% target than employment is from its maximum mandate. And that's what complicates the Fed's job. Bottom line, the Fed is stuck. And the risk of recession? It's rising. We're getting dangerously close to the edge, hence the title, Living on the Edge. 2 quarters of flat consumer spending, business investment weakness, sticky inflation. We're one adverse shock away from tipping into full-blown recession. So yes, there's still a path to avoid it, but the probability of needing earlier and faster rate cuts is growing. In the end, this isn't just about tariffs or trade deals, it's about an economic regime shift, one that could define the next several years. Thanks for watching, and if you found this breakdown helpful, make sure to like, subscribe, and turn on notifications so you don't miss the next deep dive. Catch you in the next one.